Hello, everybody. My name is Bennett Tchaikovsky, the accounting professor. We're going to go over some standard costing problems here today. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any opinions contained herein are those of myself and not my employers or other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Any unauthorized use of this video or the questions herein is strictly prohibited unless you're in one of my classes. But just if you're going to republish something, please see me first or use my materials. Okay. Let's go ahead and take a look at our question before we say goodbye. Let's go ahead and take a look at this. So we have over here, we have SFO, had the following actual fixed and variable overhead costs during the month of October. 53,425 hours of direct labor were used to produce 12,000 jackets. To produce one jacket, SFO determined that it would take 4.75 labor hours. SFO budgets variable and fixed overhead based on direct labor hours. Overhead rates are based on a production capacity level of 70%. Okay. SFO's budgeted overhead rates are based on the following production capacity. And we're then going through over here and we're being asked to go through and to determine the total overhead variance, indicate whether it's favorable or unfavorable. The direct labor variance, total overhead variance, variable overhead spending variance, variable overhead efficiency variance, and then the fixed overhead spending variance. So one of the things that I do a little bit differently in my classes is I really focus on what we call the overhead controllable variance. And what this really means is that I'm kind of looking at, we're going to look at variable overhead, and we're going to kind of see that when we see the spending and efficiency, this looks a lot like the rate and efficiency variances we saw with direct labor variances. And then I'm also going to look at the fixed overhead spending variance. And this last part over here, and we call this the fixed overhead volume variance. I put this separately, and on my exams, I include this as extra credit. And part of the reason why I do this is because it just doesn't make sense to me as your instructor or as, that should be included with really what we're kind of doing up here. So let's go ahead and take a look at this. Now, the first thing we want to do is when we say this, the thing that tricks students up on this question says overhead rates are based on a production capacity level of 70%. We are not going to use this information until we get to the extra credit, right? So just go through and disregard this. Rather, what we're going to do is we're going to say to ourselves, well, how much did we spend on the overhead? Well, we actually spent on our overhead is 1,244,800. What I need to do, and this is what we're doing here, is this is my total overhead variance, right? My total overhead variance. This is the first thing you want to go through and compute. So I've got the actual amount that I spent on my overhead. And what I want to compare it to is my budgeted amount. And the way I'm going to get my budgeted amount is it tells me that I made 12,000 jackets or 12,000 units. So what I'm going to do is I'm going to come over here to the column where it shows, oh, production in units 12,000. So this is how much we should have spent. And as I look at this here, the total amount I should have spent on my variable overhead and my fixed factory overhead should have been 1,232,625. So the total amount I should have spent in total on my overhead. Remember, overhead is going to include variable factory overhead and fixed, right? Fixed means it stays fixed. Variable means it's going to vary with production. And as we see this over here, if we look at this relation between the budgeted factory overhead and direct labor hours, we're seeing a rate of $15.50. Where did I get this number? Well, this 1550 is simply going to be the budgeted variable factory overhead, and I'm going to divide this by my direct labor hours. So when I come over here and look at this, and you don't have to do this if you're taking my class, this is going to be 773,063 divided by 49,875. This is going to be 883,500 divided by 57,000. This over here is going to be 993,938 divided by 64,125. So when we're looking at the variable overhead rate, it's going to be 1550, and then it should be the same at every level, right? Because it's variable. But when we look at the fixed overhead rate, right, the fixed overhead is the same at every level, which it should be because it's fixed, right? So, but again, what we should be concerned with first is we first need to compute the total overhead variance. And this is a very important number because it's going to help us basically determine as to whether or not we're getting the question correct. So the actual amount I spent on my overhead was $1,244,800. The amount that I should have spent at a production level of 12,000 jackets is going to be $1,232,625. Right? So over here, I'm getting $1,232,625. How did I get that number? Well, it's 349,125 plus 883,500, which is, so this is the amount that I should have spent. So when I compare the actual amount of what I spent to what I should have spent, this difference here is going to be 12,175. Now, if I spent less than what I budgeted, that would be favorable, but that is not the case. I spent 12,175 more. So this is going to be an unfavorable total overhead variance. Okay, so it's an unfavorable total overhead variance. So we're going to put over here, my total overhead variance is going to be 12,175 unfavorable. Okay, so that's the total overhead variance. Again, first thing I have to do, if you don't do this, the rest of the problem is not going to go well, right? So coming over here, I had the following actual fixed and variable overhead costs. It was 1,244,800. And let's do this. Give ourselves some more room. There we go. And let's actually give us even some more room. Okay. So I spent 1,244,000 right now. I had a budget, right? Where did I end up with on my budget? Well, if I look over here, I made 12,000 jackets. Therefore, I come over here to 80%, made 12,000. So the amount I should have spent on my factory overhead should have been 1,232,625. So this is going to be an unfavorable total overhead variance. Okay. Now let's go over here to the next step. The next question it's asking me for is, what is my variable overhead spending variance? And what is my variable overhead efficiency variance? Okay, well, I know that over here that my variable overhead rates are based on direct labor hours. So what I am going to go through and do is say, well, how much did I actually spend on my variable overhead? Well, the amount that I actually spent on my variable overhead should have been $854,800. So I should have spent 854,800, but how much did I go through and spend? Well, my budgeted variable overhead at 12,000 units was 883,500. Now, how did we get those numbers again? Variable overhead, 854,8, that's my actual amount, right? And my budgeted amount is over here at 883,500. But remember, similar to what we were doing with direct labor, is what I need to go through over here and do is I need to say my actual direct labor hours times the variable overhead rate is going to give me the total amount I spent on my variable overhead, right? So again, my actual direct labor hours times the variable overhead rate will give me the amount that I actually spent on my variable overhead, right? Why am I doing this? Well, I first go through and I compute the total overhead variance. Then I'm going to go down over here and figure out what my spending and efficiency variances are. And then we'll figure out the fixed factory overhead variance. So over here, to figure out the actual direct labor hours, and I need this to make the internal comparisons. So coming over here, I spent 53,425 hours of direct labor to produce 12,000 jackets. So this is going to be 53,425 of actual direct labor hours. Now, if I went through and I used 53,425 direct labor hours, what was my rate? Well, I can figure that out because 553,425 times X equals 854,800. So this is going to be equal to $16 per hour. So that's how much I spent per hour on my variable overhead. So again, where did I get these numbers? Variable overhead, actual variable overhead was 854,8. I used 53,425. So this variable overhead rate is 854,800 divided by 53,425. That's how I got that number. Okay. Now let's go over here. My budgeted direct labor hours, right? I should have used 57,000 budgeted direct labor hours. How did I get that number? Well, as we saw, we ended up at an 80% production capacity. I made 12,000 jackets. So I come over here to the chart. I should have used 57,000 hours. So similar to what we just did over here, I need to find out what is my, and this is my times the actual variable overhead rate. This is going to be times my budgeted variable overhead rate. My budgeted variable overhead rate is going to be 883,500 divided by 57,000 or 15.5. Remember, when I was showing you how this was basically being computed, we're taking the amount of the budgeted variable overhead, dividing it by the direct labor hours. Why are we using direct labor hours? Over here, we're doing this. It's based on direct labor hours. So now when I come over here and I'm now going ahead and looking at this, this is giving me a total variable overhead variance of 28,700. And this would be favorable. Now, I'm not asking for this in the problem, right? But we are going to go through and use this to make sure we are checking our work. So what I'm going to go through and do over here is similar to what we have explored previously, is I'm going to put the budgeted variable overhead rate right over here. And I'm going to go through over here and use my actual direct labor hours, right? It's very similar to coming over here. What value are we putting in the middle? We're putting the actual hours times the standard rate, right? This is our middle value. Okay, so in our middle value, which is the actual direct labor hours times the budgeted variable overhead rate, this is going to be over here at 828,087.50. Okay, now, before we go any further, right, we have two parts over here. We have a spending, variable overhead spending variance, and a variable overhead efficiency variance, right? These are the two that I'm going through and being asked to compute. Right off the bat, when it comes to the spending variance, I know that I'm going to be unfavorable. Why? Well, I'm going to be unfavorable because I actually spent, because we're leaving the actual direct labor hours constant. I went through and spent 50 cents more between my 50 cents more my actual variable overhead rate to my budgeted. So I know that this is going to be unfavorable, right? So the way I'm going to compute this is going to be 854.8 minus 828, 750, or a 26,712, 712.50 unfavorable spending variance. Now, for my efficiency variance, when I'm doing the efficiency variance, I'm basically comparing the actual direct labor hours I spent to the budgeted direct labor hours, and I'm leaving the variable overhead the same on both, right? This helps me go through and compare. By the way, if you're taking my class, I am not going to be providing you any of these formulas. You will need to make sure you study this and practice it to make sure you can do it. But I strongly recommend to you, you set up the questions in this way. So my variable overhead efficiency variance is going to be my actual direct labor hours times the budgeted variable overhead rate, or a negative 55,413, or this sounds like 12.5. Now, with this one, this is going to be favorable. Why? We spent less direct labor hours than we had budgeted. So this is going to be a favorable efficiency variance. How did I get 26,712? Well, this is 854,800 minus 828,087.50. How did I get a negative 55,412.50? This is going to be 828,087.50 minus 883,500. Now, one of the first things we did, remember, is I took the total amount we spent and I compared it with this, and my total variable overhead variance was favorable. When I add up these two, guess what happens? It equals the total variable overhead variance. So I know I have done this correctly. So coming over here, my variable overhead spending variance is going to be 26,712.50. My variable overhead efficiency variance is going to be a negative 55,412.50. This one here is unfavorable. My rate was higher than what I expected, but my variable overhead efficiency variance will be favorable. Now, the sum of these two plus the fixed overhead spending variance has to equal my total overhead variance. So now let's go ahead and take a look at the fixed overhead spending variance. To do this, it's very simple. I'm going to go through and say what was the actual amount spent on my fixed factory overhead. The actual amount I spent on my fixed factory overhead was 390,000. I then go through over here, my budgeted at my budget for my fixed factory overhead, if this is going to be at any level at the 80%, was going to be 349,125. So when I look at these two here, I actually spent 390,000. but I should have only spent 349,125. So the difference between these two is going to be 40,875, and this is going to be an unfavorable fixed factory overhead spending variance, right? Or 390,000, 125, 40,875. So coming over here, my fixed factory overhead spending variance is going to be over here, and this will be unfavorable. I spent too much money on my fixed factory overhead. So this is the key component of what you're going to need to go through and do on my exam, right? This next part down here is extra credit. We were going to go through and we'll do that separately. But what I want to do to make sure first that we all are on the same page, right? So again, first step, figure out the total overhead variance. We said it was over here, 12,175 unfavorable, right? I spent too much money, right, on my overhead. What I then go through and do is I'm then going to go through and then say, well, what are my variable overhead variances, right? And those are going to be the spending and the efficiency, right? It's very similar to labor. Instead of being rate and efficiency for overhead, it's going to be spending and efficiency. Same concept though. So I first went through over here, figured out, well, what was the total variance, right? Or 854,800 minus my budget of 883,500. That was my total variable overhead variance, but it's made up of two parts. It's my variable overhead spending, my variable overhead efficiency. By coming over here to the spending, where I am going through, how do I do the spending? I put the actual amount on top of direct labor hours, and I'm multiplying this by the budgeted variable overhead rate. By leaving the actual direct labor hours constant, I can then focus on the difference between these two. It's unfavorable. I spent more on a per hour basis or more on a per direct labor hour basis. Over here for the efficiency, this is going to be favorable. Why? Because I used less hours than I had budgeted. So coming over here to this part. Now, the big question is did we do this correctly? Well, if I add up the variable overhead spending variance plus the variable overhead efficiency variance plus the fixed overhead spending variance, I get 12,175. Does that equal our total overhead variance? And the answer is yes, it does, right? So it's exciting. So, okay. So we have this over here and we've done the main part of the problem. Now, what I'm going to show you here, if you're in my classroom, this is going to be part of the extra credit for the test, right? Now, you might be saying, Bennett, why are you always telling us what's going to be on the exam? This stuff is hard, right? I am intentionally giving you material that it's tough. However, you have the tools to go through and to learn it. So let's go ahead and check this out. So as I come over here and I'm going through and I'm looking at the fixed factory overhead. So it basically says over here, the fixed overhead volume variance, right? And I also asked, why is the volume variance not included in the total overhead variance? And we'll get to that momentarily. Now, when it comes to the extra credit, this is where the 70% comes in. Okay, so this is where the 70% comes in. Now, when I set up the budgeted fixed factory overhead volume, basically the fixed factory overhead budget, this was based on a production capacity level of 70%. What does that mean? It basically means that the budgeted fixed factory overhead rate is going to be based on, right, over here, the total direct labor hours, because remember, this is being based on direct labor hours, right? So this is total direct labor hours. And what I'm trying to figure out is, well, if the total amount my total budgeted fixed factory overhead was 349,125, then the budgeted my budgeted fixed factory overhead rate, right, must be what? Well, it's got to be 349,125 divided by 49,875, or $7 per direct labor hour. Okay, so again, let's take a step back. I'm asking you down over here for the fixed overhead volume variance. The volume variance is not included because it's difficult to reconcile it to the total controllable variance. So I do this separately. When I look at this over here, my budgeted fixed factory overhead was 349,125, right? This is the amount that it was set at. And this was set at a production level of 70%. When I come over here and I look at this, right, to come up with a budgeted fixed factory overhead rate, what I'm seeing here, right, how did I get these numbers, right? Budgeted fixed factory overhead was 349,125. This is based on direct labor hours, right, which in at 70%, it was 49,875. So my budgeted fixed factory overhead rate is going to be the total amount of the budgeted fixed factory overhead divided by the total direct labor hours, or at 7. Okay, so that's how we went through and did this. Now, when I look at this over here, when we go through and apply, right, the budgeted amount, applied fixed factory overhead. Again, this is extra credit. If you're watching this video and it doesn't make sense, it's okay. Again, this is extra credit. Focus on other things prior to your test. This is extra credit. I would focus on everything else first and then learn about the extra credit. So coming over here, my applied fixed factory overhead is going to be the budgeted. And remember, this budgeted fixed factory overhead, this was set at 70%. For my applied fixed factory overhead, meaning that what did I actually, I'll go through and apply on my overhead. What I do is I'm going to take the budgeted direct labor hours at the level where I fell at. And over here, I actually went through, because I made 12,000 units, I actually should have spent 57,000 hours. So coming over here, when I look at the applied fixed factory overhead at our production level, or 80%, I'm going to go through and multiply this by my budgeted fixed factory overhead rate. Now, the budgeted fixed factory overhead rate, we just went through and computed that, right? That was $7. But at 80% capacity, I would have used 57,000 direct labor hours. So coming over here, my applied fixed factory overhead, this is going to be 57,000 times 7, or 399,000. So if we do this over here, we have 57,000 direct labor hours, which was the amount, budgeted amount at 80%. And we're multiplying that by our fixed factory overhead rate that was set at the 70% level. Okay. So when I come over here, right, this is extra credit. Remember, the fixed overhead volume variance is going to be the difference between the budgeted and the applied. Or over here, this is going to be 49,875. This is going to be a favorable budgeted fixed factory overhead volume variance. Okay. Why is it favorable? Okay, well, it's not just because I subtracted this from this and I got a negative number, but if we think about it intuitively, I set a level. We always want to be more productive with our facility. We budgeted at 70%, right? We budgeted here at 70%, but we were actually more efficient. So we came in at 80%. So this fixed factory overhead volume variance is going to be favorable, meaning we were more efficient. If I come over here and I look at this question right over here, this over here was these overhead rates were based on a production capacity of 90%. But for this particular question, we were at an 80% level. And if I look at this question over here, this is going to be an unfavorable, right? Basically, this one down over here, this is going to be an unfavorable volume variance. Why is this? Why is this one unfavorable? Because we budgeted at 90 and we only came at 80. We were less efficient than what we had anticipated. Here, in this example, we were more efficient than what we had anticipated. Now, for this last part, where I'm asking the question is, why is the fixed overhead volume variance not included in the total overhead variance? And I should really say the total overhead controllable variance, but we'll just go with this right over here. So why is it not included? If we think about it, are any of these over here actual numbers? And the answer is no. This is a budgeted number, right? This 349, 125. And then my applied volume variance is also a budgeted number because we're using not the actual hours, but we're using the budgeted amount. So because the total overhead, we'll call this total controllable overhead volume variance, uses actual numbers, the fixed overhead volume variance is not included in that variance. Rather, the fixed overhead volume variance uses budgeted numbers and indicates to us how efficient we were with our production. In this instance, we set the fixed factory overhead rate at a 70% capacity. Because we came in at an 80% capacity level, we were more efficient, and therefore the fixed factory overhead volume variance is favorable. Now, again, you don't have to write out this part down here because it's not a part of the question, right? But again, could I ask something like that on the exam? Answer is sure, I can ask anything, right? But again, make sure you go through, and when you're doing these problems, you have to follow a methodology. When you're ever doing any kind of standard costing question, put the actual on the left, the budgeted on the right. Compute the total variance first. Once you compute the total variance, then dig down deeper, right? This is a little bit of a trickier question because it includes fixed factory overhead, but hopefully now after watching this video, it makes a little bit more sense. But in any event, I want to thank you for watching. If you have any comments or questions, please feel free to send them to me at 1812cpa@gmail.com. And I look forward to seeing you on future videos. Have a great day.